Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Hi there, welcome to Better System Trader. This is episode number 125. And in this week's Trading Thought, we're going to discuss an issue that all traders have to face. How do you know when to stop trading a strategy? Now, a very common approach is to wait until a strategy hits some type of, perhaps a percentage of historical drawdown, and then stop trading the system or look at modifying it or optimizing it. But there are a couple of problems with that approach. Firstly, once the strategy has hit that drawdown level, the damage is already done. You've already taken a series of losses to get to that level, so is it too late to stop trading the strategy at that point? And also, what if you stop trading the strategy and it recovers from the drawdown? You missed out on that recovery. When we have a system that goes into drawdown, we never really know if that is the beginning of the end for that strategy or if it will be a drawdown within expectation. So it can be a really tricky issue to address. Can this be managed a different way? Are there warning signs to watch out for that can tell us if our strategy is sick or healthy? And can we manage these sick strategies differently without having such an impact on our trading account? In this episode, we're going to hear from Alan Clement, who's going to share with us some ideas on measuring system health. So let's jump over to our chat with Alan. It can often be hard to determine if a system is healthy or not. Why do you think that is?
Well, the first reason is because most people don't have any idea what their system's expectation is to begin with. So it's very hard to understand. You know, if you've just bought, got a set of rules off the internet, or if you've read something out of a book and just tried to apply it. So it's the first thing you have to do is to use a systematic approach to establish what the realistic expectations are for the system. So that's going to give you what I would call the long-term metrics for the system. So what is the drawdown expectation? What is the win rate expectation? The holding period, the expectancy, risk return, all those things. You'll have some sort of expectations of what the system can produce over the long term. Now, as we know, that not all systems work through all market conditions. It just doesn't work like that. Markets go up, they go down, they go sideways, they go from high volatility to low volatility, and there's no one system that's going to be able to handle all those various types of markets. So we have to expect that there's going to be outperformance and underperformance in the systems, and the results of any system will tend to wax or wane. Even if you've got the logic in it to turn off when it's not the optimal conditions, then that's going to create a flat spot in the equity line. But if you don't have that, you can have some way of establishing whether the system is performing as expected, or whether it's underperforming, or even whether it's sick or broken. When we have a system that goes into drawdown, we never really know if that's just going to be a drawdown that's within the realms of expectation, or whether this is the start of the end for the system altogether. So, the way to think about it is the model of the system is fixed. We have a fixed set of rules generally, and a reasonably fixed set of parameters, and the market data is dynamic, so it's a moving target, and so the model can either be in sync with the market data, or it can drift out of sync. And when it drifts out of sync, that means that it's going to underperform. Generally, the win rate will drop. Generally, the drawdown will increase. Those all the things that we don't like about the system. So what you can do is you can look at basically the short run metrics against the long run metrics. So you've got your long in sample out of sample back test that you've established before you started trading the system, and then you can look at what has it done in the last. I mean, this very much depends on how frequently it trades, but say what has it done in the last 10, 15, 20, even 30 trades or whatever, and you can use that once again, that rolling window to determine what the short run metrics are. So we take an example, say a mean reversion system, which has a fairly high win rate of, say, 75%. That means that we would expect that we should get 7 or 8 winners out of each 10 trades. Now, that very rarely happens that it sits on that sweet spot for very long. What tends to happen is it will either be above that, and you can get periods of 9, 10 winners out of 10 for quite a while, and conversely, it can drop way down, 6, 5, 4, 3, 2, 1 winner in the last 10. So what you can do is you can establish some sort of limitation whereby you will stop taking new entries at a particular point, and this is what I call the system health. So you can look at things, and I've come up with my own algorithm, if you like, which looks at both win rate, open drawdown, closed drawdown. But you can look at any metrics you like to determine that. You could look at the drop off in the return. You could look at whether it's drifting away from its standard holding period, those kinds of things. But however you measure it, once you establish a set of minimums for that system health, and once it drops below that level, then you basically stop taking new entries. You allow the system to keep taking trades, if you like, in whichever tool you're using to log the trades or to generate the signals, and then you basically monitor the system while you're not taking any new entries until hopefully it comes back into sync with the market. And once it jumps up above those minimums again, then you start taking entries once again. Of course, if it's completely broken, it's never going to get to that point again. But what you've done is you've established a minimum that's going to basically it's going to stop your drawdown, or it's going to limit the amount of drawdown that you take in that system. So it's going to protect you from trading that system into the ground until you've blown your account up.
That's really interesting. So if you use this approach of comparing the short-term run with the long-term, how do you actually establish a level that you're happy with? Is there a way to quantify that, or is that just a subjective matter?
Well, to me, it all flows from your own objectives. What is it that you're trying to achieve with this system? Your expectation will be for it to generate a certain amount of return. You will be comfortable with a certain win rate, and drawdown as well. So, you could say that if you've established what the worst drawdown is that the system's had over whatever test period you've used, then you can say, well, if it reaches a certain percentage of that maximum historical drawdown, then that's the point that I'm going to stop taking new trades. So that could be, say, 70% of the historic maximum drawdown. Now the chances are it will move through that, because you'll probably have open positions that will take it lower than that. But if you don't add any new entries to that, then you're going to avoid taking additional drawdown. So if you think of a trending system that hits a bear market, for example, while it's got some positions open, those are the ones that are going to get hit. But if you get signaled to take new positions, which may, in all probability, turn out to be losing positions, then if you can avoid taking them, that's going to stem that tide of drawdown. Similarly for win rate, again, if you have a system that wins 7 or 8 times out of 10, then you might think, well, if it drops down below, say, 5 in the last 10 or even 4 in the last 10, then to me there's something happening that the system can't cope with in the market. So I'm just going to take it offline, and I'm just going to sit and wait for that win rate to get back up. And these types of things work much better on systems that trade more often. So they're very good for things like mean reversion systems. For trending systems that are lower frequency, they tend not to work quite well, because you can end up sitting out of the market for a period as the thing is starting to recover. And as we know, sometimes the start of new trends out the bottom of bear markets tend to be some of the best times to be in this system. So it's very much horses for courses, and you have to sort of adjust the metrics that you're using. But in general, it will give you a level of safety that's out with the standard risk management tools.
Thanks to Alan for sharing his ideas on measuring system health. If you'd like to hear more from Alan, including some additional tips on measuring system health, plus other topics like managing drawdown and dynamic position sizing, then head on over to episode number 29 of the podcast, where I talk to Alan about some of those things. Go and check that one out, and I hope you enjoy the rest of your week. Bye. Okay, well, that's it for this episode. Thanks for listening. I hope you enjoyed the show. Come on over to bettersystemtrader.com. That's where you'll find all the previous episodes, all the transcribes, all the show notes, and all the free weekly trading tips. bettersystemtrader.com.